the natural gas market edged slightly lower over the past week, as heating demand continues to fade. At this stage, questions surrounding demand remain a key focus for the market. The natural gas market made an early attempt to rally during the week, but the area above the $3.50 mark continues to present strong resistance. Given the seasonal decline in demand, it's not surprising that the market is facing increased uncertainty and scrutiny at this time. Additionally, recession concerns are weighing on the outlook for electricity demand, which could lead to further declines. In fact, yesterday's EIA report revealed that total U.S. nat gas consumption dropped by 5.4 billion cubic feet per day compared to the previous week. The largest contributor to this decline was the residential and commercial sector, where consumption fell by 14.1% or 3.5 billion cubic feet per day. Power generation also saw a week-over-week decrease of 5.4% or 1.6 billion cubic feet daily. At the same time, dry natural gas production increased by 0.5 billion cubic feet per day, averaging 106.3 billion cubic feet daily, while average net imports from Canada declined by 0.6 billion cubic feet per day compared to last week. Moreover, unseasonably warm weather is expected to persist across much of the U.S., with temperatures ranging from the 60s to 80s in key regions, significantly reducing heating demand. This mild pattern may continue through late April, supporting stronger storage injections. As a result, nat gas inventories are projected to rise by 369 billion cubic feet during the 4-week period from April 12 to May 9, approximately 90 billion cubic feet above the 5-year average. This development would represent a significant inflection point, shifting the current storage deficit to a 12 billion cubic feet surplus relative to the 5-year average for the first time since January. Such a reversal underscores the growing imbalance between supply and demand and presents a fundamental headwind that bullish narratives can no longer dismiss. It may be purely coincidental, but May 9, Victory Day in Russia, is a highly symbolic date. If Trump and Putin were to reach an agreement around this time, the market could react sharply. News of sanctions relief, followed by a potential surge in Russian gas flows, could trigger a significant drop in prices. Of course, this would be a doomsday scenario for gas prices, a sudden unraveling of bullish hopes. But with Trump's trademark unpredictability, nothing is off the table. Escalating tariffs between the U.S. and China have shaken macroeconomic confidence, prompting significant downward revisions to global oil demand growth. The EIA has cut its 2025 forecast to just 900,000 barrels per day, while the IEA went even lower, projecting a mere 730,000 barrels per day, the slowest pace since 2019, excluding the pandemic years. These cuts highlight not only the risks posed by trade tensions but also broader concerns, including weakening industrial activity in Asia and softening consumer data in the U.S. Still, for traders, these long-term projections do not rule out the potential for sharp short-term price moves. A rollback of tariffs by the U.S. or fresh signs of economic stimulus from China could swiftly shift demand sentiment, if only for a limited time. Structurally, the market appears bearish. Weak demand, surplus supply, and subdued price forecasts all suggest a tough few quarters ahead, possibly pushing prices below the $60 mark. However, from a tactical standpoint, traders should remain vigilant. Any easing of tariffs, stronger than expected Chinese demand, or geopolitical tensions could spark short-covering rallies. From a technical standpoint, the bears still have the upper hand. Even with the latest EIA storage report coming in bullish, the bulls still couldn't muster enough strength to break through the stubborn $3.30 barrier, a telling sign that the bearish grip on this market remains firmly in place. In the near term, nat gas prices are likely to remain under pressure, with a move toward the $3 retracement level in play, and possibly even down to key support around $2.50. Given the combination of mild weather, robust supply, and weak demand, any rallies are expected to be short-lived and likely capped near $3.30, unless a fresh demand-driven catalyst appears. Drop a comment below. Do you think nat gas has a shot at breaking above the $3.30 resistance next week, or is that just wishful thinking at this point? Please like, subscribe, and comment to support the channel. See you in the next one.